Hello, Jim here. I've been on a journey to learn the right way to trade options, and one of the most important parts of that is finding really good companies to trade with. Today, I want to talk about two that have been on my watch list for quite a while, but I recently made trades on them. I'm going to talk about how I found them. I'm going to go through Seeking Alpha and share with you why I like them. And in the end, I'm going to share with you the actual trades I made earlier in the week. So be sure to stay till the very end. I think it's going to be well worth your while. Jump into the first company, and that's NETAPP. NETAPP is a cloud-based service company. They work with Amazon Web Services, Azure, Microsoft Azure, even I believe the Google Cloud. So I like them. I know there's hold on SA Analyst, Wall Street, and Quant, but they've been on my list a long time. So this is the first trade I actually did with them. So are they overpriced? I don't think so. They're currently have a PE of around 17. They're bringing in pretty good earnings, around $7. They did fall back. They did meet earnings. We can come over and look at earnings here. So they just had earnings last week. They beat it, but they didn't beat it by as much as I guess Wall Street wanted to see it. So they did fall back, just like NVIDIA. They fell back a bit, and I decided to make a trade on them that day where I believe they were down like 5-6%, something along those lines. Their next earnings isn't until late in November, so I can probably make two trades. The trade I made this time, I did expiring October 18th, and then I can do another one. I believe 11/15 is the November monthly expiration. I prefer to do the monthly expirations. And then down here you can see their year-over-year earnings looks good, not great. They do have 1 month that may be lower, but you can see every month they beat earnings, so they've done well there. Growth is so-so, not the best. Aspects of it are good. Some aspects aren't as good. Gap growth isn't as good. And then profitability, they have very good profitability. I mean, return on common equity over 120. Return on assets. So I'd like to see return on equity over 30%. They're 120%. They're in the realm of like Apple. Return on total capital looks good. Return on total assets. I'd rather this be a little bit higher, but 13 and above is what I like. But this is pretty close to 13. Dividends. They pay pretty good dividends, and they've been increasing them. I think they were flat the previous year. So they didn't grow them this past year, but they're paying not a bad dividend. Now, if we come over to Schwab, you can see a little bit more detail about the dividends. So next one will be October 23. The X date will be actually October 4th. So that's coming up in a little bit over a month. And we can expand on this. I like how Schwab does this. And I can look here and you can see they've been increasing dividends pretty well. They did not increase it this past year. If you go back, so last year they did $2. If you go back to 2014, 10 years, they were only paying 63 cents. So long term, you can see that 10-year growth rate 16. So they just recently came a little bit off of dividends. I do like this other section with Schwab where I can compare them to other companies. I also like Logitech. I do a lot of trades on Logitech. They look similar. Now, Logitech has no debt, so I do like that aspect. They do have a bit more debt than I like, but their profit margin looks good. It's even higher than Logitech's, and their earnings per share growth 3 to 5 year period is a little bit lower than Logitech. Now, here you can see debt. The debt's a bit high compared to total equity. Now they have been paying it down. It was almost 2.6 billion, and so they've been paying it down. So hopefully that will continue. So that's a positive. It's a little more debt than I typically like. So now if we actually look at the trade I did, I'll share with you. Let's open this. This is the chain. I just took a screenshot of it, and you can see here I had two choices. I could do 115, and here you can see the stock was down $8.76. So I could go with 115, which was a 22 delta, and pick up between 155 and 175, or I could do a 12 delta and bring in 75 to 90 cents. I decided to go with the 115 and do the 22 delta versus the 12 delta. And then I also purchased the put here, which was the $100. I meant to do the 105, but I was playing around with it, and I think I was messing with limit orders, and somehow I put 100 in there. So I have 115 and 100, and you can see what that looks like here. Here's NETAPP. I did it on 829. In my Fidelity IRA, I did a vertical put credit spread, 115, 100. So I am taking a little bit more risk, about 1,500 per contract. And I did 2 contracts. It was 22 delta expiring October 18th. The price was 123.15 at the time. And I brought in 270.38. Again, the required capital was a bit higher, so my return was a little bit lower than typical. So it worked out pretty well. Now, if you're a member, this is what I share with my members. I can show you here. So I release this literally after I make the trade, and I provide it to my membership. I talk about the different, how much I brought in, the expiration, how much premium I brought in, the different strikes, why I decided to make a trade in them. I do a lot of Azure and AWS work. I'm a software consultant, programmer, whatever you want to call me. I kind of do it all. So I've actually worked with NetApp's software tool set. And here you can actually see the trade. And I paid quite a bit for the put, even though it was 110. But with this economy and what's going on currently, I do think it's wise to be purchasing puts and doing vertical put credit spreads versus cash secured puts. And then if you want to learn more about my memberships, I typically encourage people, in the description will be links to it. I also am a affiliate to Seeking Alpha if you want to learn more about it. They are giving a bit of a discount currently, so the link is there. I do get a little bit of a kickback from it, but it's no more cost to you. Actually, I believe you have to go through an affiliate link to get the discount. So if you're curious about that, take a look. Like I said, I provide this to all 3 levels of my membership. My second higher membership includes everything that's in what I call, this is my investor club. I also have Traders Club, and every other week we have another meeting next Sunday where we're going to talk about, we haven't set a topic yet, but in the past we've talked about all sorts of things that the members wanted to talk about. We talked about ChatGPT, different types of AI. We've also talked about zero DTEs, the different brokers. And that's also all available here. If you go to the main page, and you can see here, I've got collections, first steps. Yeah, here's the collection. So I have different collections people can access, and all my Trader Club meetings are right here. So they're accessible to even people in the Investor Club. I try to make my memberships very affordable so that people can access them, and it doesn't become a big burden to pay for. So here's the last one we did, and again, all these are available. A lot of really good discussions. Different people will share different information. I know we had Mike share at one point. So it may be worth your while. I encourage you to take a look. So that being said about NetApp, let's jump into the next stock that I want to talk about, Applied Materials. Okay, the second company is Applied Materials. This is a company I've traded on before. I do really like them. They're currently just like AppNet. They're not overpriced. I don't think they're overpriced, at least not by a crazy amount. They may be a bit overpriced, but they have earnings per share $8.52. The PE is 23.14. Now, they do have a bit more growth, and they are a chip manufacturer, but they're a little bit more diverse than a lot of the other chip makers. You can see down here what they do. Yeah, here we go. So, they engage in the provision of manufacturing equipment, services, and software to the semiconductor, display, and related industries. So they're not just making CPU chips. They're a little bit broader. Let's look at earnings. Their earnings they just had on 8/15, so they do have earnings close to their November expiration, so something to keep in mind. But they did beat earnings, and they beat earnings all year. You can see every quarter they've beaten it, and they've got some pretty good year-over-year earnings. Not great for fourth quarter 2024, but pretty good for first quarter 25. Second quarter 25 looks really good, and so it looks like they're going to grow quite a bit more in 2025. And then if we look at growth in general, a C, again, for a gigantic company like this, it's hard for them to match the growth that a lot of little companies have, but some aspects look really good. Working capital growth looks good. Their dividend per share growth, so they are increasing dividends nicely. Their 1-year dividend growth rate, 24%, is good. Now profitability, they also have good profitability, return on common equity over 40, almost 44%. And then their return on assets is over 22%. So they're a well-run company. They do a nice job with that. We can also look at dividends. I prefer to come over here and look at dividends on Schwab. And you can see here they have an A rating. Not that Schwab's equity rating means much, but I do kind of still look at it. And you can see here they 1 year, not majorly overpriced, but or not overpriced at all in my mind compared to some companies. If you look at a company like Palantir I think has an 80-some PE. Now they do have better growth, but not outrageously better. I think I really like Palantir, but I do think it's overpriced. And you have to be careful. There's still a lot of YouTubers that are saying buy more, buy more, buy more. I think it is current PE. If we do have a correction, it's going to dive. But see, here's the dividends. I don't think they've been paying them very long, but they've been increasing them nicely. Recently, they majorly increased them to $1.22. So not a big dividend, but the fact that the way they're growing them, I mean, they'll be doubling every 2 to 3 years. So if the stock price grows modestly, but they're increasing dividends substantially, the dividend could be 2 to 3% within 4 or 5 years. I wouldn't be surprised. And then, like I said, earnings, they've done well. Like to see how they do compared to their competitors. The earnings per share growth looks good, the forecast. And their profit margins look good. Maybe not as good as some of the others, but still very good. I mean, looks like Texas Instruments, but may have a little bit better profit margins. And then their debt's fine. So their debt's been kind of in this 5.5 billion range, but their equity is quite high, almost 16. So those are the things I like to look at for the company. Now, let's jump into the spreadsheet, and here we can see I made the trade on them at 826. This is my planning worksheet. The green just means it's a new trade, a vertical put credit spread, 175, 165. So we can see here the price currently is 196. So they did go up $4 on Friday. So it's pretty far out of the money already. I might be able to get out of this trade really quickly if I need to. 196.79. And I believe that was the price I just looked at. 317 is what I brought in. My required capital, again, is the 2,000 minus the 317.24. And it's like 130% return, which is just this divided by this and then adjusted for the year. So 365 divided by 53. So 53 is the DTE, which is days till expiration. So 130% return. Now, a lot of my other trades, like this 498, I closed early. So my guess is I'll be able to close them early too. So let's actually look at what I sent out to my membership. Here's AMAT. So sold 2 vertical put credit spreads, like I was talking, 175, 165. Here's the calculation. The delta was 0.1847. talks a little bit about why I like them. They have a great return on asset, really good return on equity. If assigned at 175, the PE ratio would be right around 20. Plus, if there's a major dive, the put that I purchased at 165 would be worth a lot. A lot of times I end up keeping the stock and then I'll sell the puts, especially with an early assignment. Like I did that with Dell. I think Dell, I ended up picking up $5 or $6 per share or something along those lines. So my cost basis with Dell currently, I believe, is under 100. So, and I could have also taken less risk, going 170, 160, and brought in around 230 in the premium. I also a lot of times will talk about, well, I could have done a cash secured put and again would have brought in a lot more premium. And, as always, I try to provide as much information. My goal is for my members not to copy my trade, for them to think on their own to determine what's the best trade for them. They may want to take less risk, more risk. They want to, if you're taking less risk, you're going to go with a lower delta. You may bring in less premium, but again, if the stock or the market dives, they're taking less risk in those instances. So that's Applied Materials, and again, it's a company that I've been interested in a long time. I currently don't own any, but I've done a number of trades on them over the years. So, as always, thanks for joining me. If you have any comments or want to, share a stock or something, please leave a comment. I typically try to get to them within 48 hours. If I missed something or I was unclear in the video, also leave a comment. Let me know what your questions might be. Or if, you see something that maybe I should have done this differently. Again, I don't take anything personal or typically try not to. But again, thanks for joining me, and I look forward to seeing you next time.